Hey there, everyone. Happy Monday, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast but not rainy Redmond, Washington. Thanks for joining me here every weekday after the close as we break down the market action using the best practices of technical analysis. And last week, quite a breakdown. Although today we had a bit of a recovery, we're still below that line in the sand, 58.50. Did a video on our YouTube channel on Friday, really focusing on that breakdown of the line in the sand, thinking about some downside price objectives based on a couple different techniques. So if you miss that, I'd encourage you to check that out for sure as we think about what may come next here. We've been talking about a lot of the evidence that has been weighing on this market really from mid-December now till mid-January. Certainly by any, I would say, any technical definition, it feels like a change of character has occurred. Now, what's next? It's all about the price and following the price action. So with that in mind, let's get to the market recap and focus on how things played out. The major averages kind of mixed today, and I would say the general trend to this day was opening lower and trading higher through the course of the day. Friday, of course, was reaction to the latest jobs number this week. We have two key inflation readings, the CPI and PPI, to think about. And as well as earnings season kicking off here, really on Wednesday is when things start to light up with a lot of financials reporting. Today, S&P 500 finishing just slightly higher, 0.2% to the upside. So the S&P closing around 58.36. The Dow actually led the way higher, excuse me, up about 0.9%. And the Nasdaq Composite actually lagging down 0.4%. You can see mid caps and small caps in the green. The VIX slightly lower. So sort of a choppy mixed day. I mean, sort of the lower open sort of felt like we could really accelerate to the downside. But, you know, in the short term, you're seeing buyers come in here. The phrase dead cat bounce will be floated around on a day like today when you have the market, in a short term downtrend and then getting any sort of counter trend rally to the upside. Dead cat bounce, of course, a horrible picture painted by that phrase, but it's reference to the fact that you're in a downtrend. You have that short kind of quick bounce higher before the downtrend resumes. So we'll see how the rest of this week plays out. But again, 58.50 continues to be the main level that we're watching. As long as we remain below that, and I would argue at this point, every day we remain below 58.50. Certainly puts an exclamation point on sort of that breakdown thesis that we talked about going into the end of last week. Interest rates generally moving higher here. You can see the 10-year yield just above 4.8%. The long bond yield just barely remaining below the 5% level, very, very close to doing so. And again, 5%, sort of that high watermark for the 10-year yield that we saw going back over the last 12 to 18 months. And so the question is, does the do rates push above that level now that the short end of the curve, the where the Fed is active, appears to be stable here in the short term? Does the long end of the curve continue to push higher as bonds trend lower? I would say nothing on the chart of the TLT or the AG or any of those bond price ETFs give me any signs of bottoming just yet. I think we're still sort of in that downtrend phase. And again, rates kind of going up as a result. The dollar index continuing to push to the upside, not by much, about 1/3% for the dollar ETF. But I would say, generally stronger dollar has been a big warning sign here from Q4 now into Q1 of the new year. That continued stronger dollar, again, more and more just makes 2025 look a lot like 2022. And that was another year where you had a pretty strong bull market phase, of course, with low volatility. Then the calendar changed, and all of a sudden everything was different. And all of a sudden you saw a lot more distribution, risk assets coming off, and very few things rallying. The two things that stand out would be the dollar and interest rates. And, don't look now. That's kind of what we're seeing here today. All right, looking at the commodity space, you can see gold and silver moving to the downside. The GLD down about 1%. Silver price is down over double that, about 2.4% lower. Copper price is slightly higher. Crude oil actually getting a decent day, and energy toward the top of the leaderboard today, as we'll see in a moment. Precious metals coming off here, and that's we'd sort of seen gold prices not really trend higher, but really bouncing off of support. I would say over the last couple weeks from December into January. Today, kind of giving a little bit of that back, but certainly something to watch. as we, the gold and the dollar can go up at the same time. They can go down at the same time. A lot of times we assume an inverse relationship, same as gold and stocks. We assume an inverse relationship that isn't always there. It's actually not a very stable relationship. I would say, well, there are times when gold and stocks will move differently, when gold and the dollar will move differently. There are times when they will actually move in the same way. And perhaps we're seeing that here. Gold today down, silver down as well. Looking at the cryptocurrency space, super choppy, and Bitcoin briefly traded just below 90,000. Almost looks like a bad tick there, and I don't really know if that was what was at work here over the last 12 hours or so. But Bitcoin coming off quite a bit, certainly down toward that 90,000 level, pushing back up all the way back up to around 94,500, which is where we're at as we go live today. Over the weekend, sort of languishing in those mid upper 90 ranges. So coming off a bit, but rallying as equities rally through the course of the equity trading day. Ether prices still relatively weak, and you can see Ether down, getting toward 3,000. Actually traded right down to 3,000 earlier today, but again rallying along with stocks going into the equity market close. Cryptocurrency is obviously a very volatile space, and I always, when people ask, Bitcoin up 5% or down 5%, what's going on? My answer is kind of normal. That's just sort of the normal amount of volatility. I would say when it isn't moving that significantly, that's a story because there's maybe a little lesser volatility than normal. Those are volatile assets that sort of comes with the game, and so if you're in that space, you have to brace for quite a bit of movement. Looking at the 11 S&P sectors, we can see 9 out of the 11 finished in the green. It wasn't the case earlier, right? Out of the open, you saw most of these actually down. And every time I'm checking on the markets, I found like 1 or 2 more sectors were going higher through the course of the day. End of the day, most everything ended up being positive. Materials and energy, 2 cyclical sectors, 2 sort of value-oriented sectors at the top of the list, both up over 2%. Materials up 2.25%, energy up 2.1%. You go all the way down to technology and utilities, which are the only 2 sectors actually in the red. So utilities, which traditionally a defensive sector, but has had some growthy characteristics recently with all the energy requirements for AI and for other newer emerging technologies. However, utilities today down 1.2%, tech down 0.7%. Our market trend model, we didn't have a show on Friday. Apologies for that. But, if you look at what happened going into the close on Friday, market trend model, no real change, if I remember right, from the week prior. The main market trend model that I watch is on the S&P 500, the medium-term model remaining slightly positive. We'll see through the course of the week if that would turn negative. If so, that would be the first time since late 2023. And that, for me, is kind of my main risk-on, risk-off measure. So when the medium-term model on the S&P turns negative, that tells me to get more defensive, to be lightening up on risk assets, to be preserving capital as much as possible, and really, building up cash to be able to reallocate at a lower level. So very close to doing that, not quite doing that. For what it's worth, in the small cap space and the mid cap space, that medium term model has already turned negative as of Friday's close. So I want to point out the breadth ended up starting really weak, ended up finishing pretty positive just for today. Obviously, we've covered the larger theme of breadth indicators, rotating to more negative readings here over the last month or so. But as of today, 3 out of every 4 S&P 500 names finished in the green, and that shows you the nice bounce off of the low reading that we saw earlier in the day. Looking at the at the Magnificent 7 stocks, the mega cap growth stocks, you can see Tesla having a decent day, up over 2%. Netflix essentially up about 1/3%, but the rest of the Magnificent 7 stocks all in the red. Nvidia down 2%, Meta and Apple down just over 1%. So, I would argue any sort of bull market outlook from this point on, if you're all bulled up and you expect this to be a very buyable dip that's going to resolve to the upside and push the S&P beyond 6,100 to greener pastures or bluer skies above there, I think it has to include these names, because if these names are struggling and like energy and materials are really working, the benchmarks are still going to remain fairly weak, even though those areas of the market are showing strength. There's just not enough market cap in those sectors to move the needle on the benchmarks. But these growth stocks and growth sectors, those are the ones that really can can significantly move the benchmarks higher. So besides Tesla and Netflix, pretty much everything finishing in the red today. All right, let's go to the market carpet. This is a heat map style visualization. As we bring that up, I just want to remind you, I can't see all the questions that are coming in on all of the different platforms where we live stream. We're on Facebook, on LinkedIn, on YouTube, and on X. So I'm so thankful if you're watching this live. You had the opportunity to ask questions on any of those platforms. Just put it in the comments section wherever you're watching the live stream. Try to grab a question or two before the end of the day here. And anything we don't get to, we will put it in the mailbag. Apologies again. I meant to do a mailbag episode on Friday. Wasn't able to get that done, but hopefully end of this week we will do one. Had a lot of really good questions that we have queued up for that next episode. We can always use more, so put your questions in now. Looking at the what's called the market carpet on stock charts, it's interesting. First thought is just the overall takeaways. I mean, I'm struck by how some of the larger sectors like technology, communication services, some of the more growthy sectors, the FANG sectors, not very good. And if I'm just mentally rank ordering the most green to the least green, these kind of get my votes for the least green, right? The least positive today in some of those growth sectors. There are areas of the market that had a pretty decent day, right? Healthcare, industrials, energy, materials, maybe financials, not perfect, but the number of stocks rotating higher. And what's interesting there, as you think about it, is that earnings season kicks off this week and really launches on Wednesday with a bunch of banks reporting, some regional banks, some money center banks, Citigroup, JP Morgan, Wells Fargo, all on Wednesday, if I remember right. And so, certainly an opportunity for financials to resume some sort of leadership role. If you get good earnings, the steeper yield curve would imply that might be something we'll hear about. Curious to see how often that would come up and what sort of outlook that implies for some of these financial institutions. But for today, again, some of these sectors actually did quite well. So while the benchmarks opened lower and again traded higher through the course of the day, it's worth noting some areas of the market actually had a pretty decent start to this week. I would especially note materials and energy. Those are the two top performing sectors today. And you can see almost all of those names, S&P 500 members in those sectors finished in the green. The challenge from a technical perspective on some of those energy stocks, and I grabbed one or maybe two for the chart review here in a moment, is these are coming off of really beaten down levels, right? So a lot of these energy stocks have been in primary downtrends for so long. They're having a really nice start to the year, but again, they're still down a ton over the last 3 or 4 months, right? So, again, nice rally off of very low levels is a tough one to sort of play, because the question is, how sustainable do you think that's going to be? Big play on crude oil prices, of course, if you're trading energy stocks right about now. We have that chart queued up here in a little bit. One other takeaway is I'm kind of a stream of consciousness going about the market carpet, noticing some of the bright red in the technology sector. Again, this was the worst performing sector, but NVIDIA, of course, down 2%, pretty much hurts. But Palo Alto Networks down over 3%, Micron down over 4%, Amphenol down almost 3%. These are stocks that actually had been doing pretty well, right? You had PANW pushing above $200 a share about a month ago. We're now down below 170. Micron has not been a particularly good stock, but I would say that this pullback takes it below 100, sort of big round number resistance. Amphenol was actually up to 75 mid-December, now down below 70. So, some of those top performing names, stronger charts, a lot of them had shown bearish momentum divergences going into that December peak, right? November, December higher prices on weaker momentum. We highlighted some of those through the course of the week so far here in recently on the show. But I would say Amphenol, just the latest of those names, kind of pulling off of those highs and now starting to break down a bit. And that's what concerns me about a recovery, is seeing names like this just continue to break down. The more of those happen, the less likely it feels like we just get a nice big resumption of the uptrend. We'll see. I skipped sort of the big names, and I would say, again, a lot of these were kind of flat mixed, but Meta, Apple, NVIDIA down over 1%, all of those. The only real Magnificent Seven kind of bigger name having a decent day, Tesla. JP Morgan, which I'm well aware is not one of those FANG names, is one of the larger names in the financial sector, having a pretty decent update. And again, I'm immediately thinking of earnings coming up later this week. Thanks for hanging with me, by the way. I'm having some chronic congestion issues that I'm trying to work through with limited success. But hey, always hopeful. I may not be. I'm actually pretty much an optimist, so I'm optimistic of a full recovery here very soon. But it's making doing a show not perfectly comfortable, but we'll get there. Looking at the daily show to the daily chart of the S&P 500, that is, I was talking to my premium members at Market Misbehavior over the weekend in my report. And again, I would not describe this head and shoulders ish pattern as a perfect textbook head and shoulders by any means. We have a head, we have two right shoulders and one left shoulder, so I'm well aware of the imperfection by this particular pattern. However, whether or not you label this as a head and shoulders top, whether or not you label this as a perfect topping pattern, I would say the fact that we had a level of support that's broken is a concern. Now, on Friday, we closed below 58.50. That was our line in the sand. Through the course of the day, my phone's lighting up with the alert that I'd set for that level, and we're seeing a breakdown. Today, Monday, we opened much lower. So right out of the open, I'm immediately thinking, ooh, that might be that downside follow through we were talking about. We did close slightly higher, but still below that 58.50 level. So for me, we need to get back above there to be anything but pretty negative, at least about the short-term trajectory. And I mentioned the video on my YouTube channel. If you haven't had a chance to watch that, I would check that out at the end of the show, or when you have a moment. The classic measurement kind of gives you a downside target of around the 200-day moving average, right around 5,600. I think that's a reasonable downside objective given a followed through or a confirmed breakdown of that 58.50 level. At this point, I'm assuming that that's happening unless we get a nice bounce back above 58.50, then we try to reassess, and maybe that happens tomorrow. And boy, that'll be something to talk about for sure. But for now, I'm seeing again lower lows as we drift below that level, remaining below 58.50 on a closing basis. That's a concern. All right. This chart is called the chart. This is something that I refer to pretty often in my work, and it really combines some of the key, breadth and what's another word? Mainly breadth indicators, to be honest with you, that I track to sort of evaluate the overall conditions around the S&P 500. I have someone, and this chart particularly was created. I designed this years ago because someone at a couple shops ago used to ask me, what do the charts say about the markets? What do the charts say about gold? What do the charts say about the S&P? And so I jokingly just created a chart called the chart. And I would just say, yeah, here's the chart, as if I just had one. And I was like, oh, this actually is kind of helpful to just have one chart that kind of comes up with the key levels and trends that I'm trying to track. So indeed, while the S&P 500 has been trending lower over the last month or so, we can see the cumulative advanced decline lines all rotating lower. This is the NYSE advanced decline line. There are others that I track as well for different what we call cap tiers, different types of stocks, large to small cap, and everything in between. They're all breaking down. They're all trending lower over the last 6 to 8 weeks. And so that rotation from a very bullish trend going into December of last year to now very much a distributive pattern that we've seen in the last 6 weeks tells you the change that we've observed in the market conditions. In terms of stocks above their 50-day moving average, which is one of those great kind of short-term breadth indicators, you can see we're down to around 20%, which means only 1 out of 5 S&P members remains above their 50-day moving average. Pretty much everything has broken at least that initial short-term trend barometer. Most S&P members still, as of last Friday, remained above their 200-day moving average. And I would imagine after today, it's probably right around there as well, just about 50%. That breaks below 50%. That would be a concerning development, and all of a sudden look a lot more like a deeper correction is likely. For now, it's kind of holding in there okay. In terms of the bullish percent index, this has come down quite a bit. We're now just below 40%, lowest level we've been since October of 23. And so what's happened is a lot of individual stocks over the last couple of months have given sell signals from their point and figure chart, right? They've had a distribution pattern, and point and figure charts are interesting to watch in this sort of environment. If you know point and figure charts, it takes quite a bit to register a sell signal. When you have a chart in an uptrend, you actually have to come down quite a bit to generate the sell signal by going to the next column and undercutting the previous column. It's a whole part of the point and figure methodologies that it's not particularly easy to determine a trend change, right? It has to be quite a significant move. So when so many stocks are generating those sell signals, it tells you there's a lot of distribution out there. Now, with all of that in mind, obviously quite a bit of negativity from some of these indicators, but not all is negative, right? And to be clear, I'm seeing plenty of things that tell us that the markets are not a disaster just yet. One that comes to mind would be measures of offense over defense. Defensive sectors like consumer staples, like real estate, which if this market is really dangerous, I would expect a surge in the relative performance of some of those defensive sectors, implying that institutions are getting more defensive. They're rotating to the defensive areas of the market. If they still have to own stocks, they want to get into low volatility, high income paying names and kind of ride out a period of market uncertainty. You're not really seeing that, right? You're seeing offense outperform defense. We're showing that here by the equal weighted consumer discretionary versus the equal weighted consumer staples ETFs, still trending higher. So you're still seeing offense over defense. And that has been a consistent reading that we've observed really since the August low from last year. So, not all things are so obviously climactically bearish that I'm screaming, this is the time to really get out of the way. I still think we're in a pullback within a larger uptrend until proven otherwise. And I unfortunately think we might be proven otherwise here in the coming weeks. But I will wait for the chart to tell me that is the case. I did see a question, by the way, about small caps, about the IWM. And I would say, what's interesting about the chart of the IWM, and this is a Russell 2000 ETF. Just a great way to track the small cap space overall. I've drawn a bunch of lines on here, and I'll kind of talk through each of them briefly so you get a sense of where we're at. I brought this chart up because the Russell 2000 ETF is testing the 200-day moving average. Today, we actually opened just slightly above that. We traded almost to the penny down to the 200-day moving average and closed back just above 217 on the Russell 2000. Now, that's down from around 244, which is where we were about 6 weeks ago at the end of November, right around the Thanksgiving holiday. From the end of November to now, we've dropped quite a bit, right around 30 points, 15% or so on the small cap space. Now, what's interesting is if you draw a trend line from the October 23 low, kind of the low for the last couple of years, you connect that to the most, sort of another intermediate low here in early August of last year. That lines up with the lows that we were testing mid-late December, and that's what we just broke down through on Friday. So some longer-term trend lines on things like small caps appear to be breaking. The 200-day moving average still holding for now. The 38.2% retracement of that uptrend still holding. That's just slightly below current levels around 211, which means small caps get down to 210. That means we're breaking trend line resistance, trend line support, moving average support, Fibonacci support, all of those things, called a confluence of support. On the S&P, that sort of confluence of support is down around, what was it, 5,600? 5,600, right around here. That's where you have the Fibonacci support and moving average support and all of those things. Here on the Russell 2000, we're kind of facing that level now, and it's sold off a lot more than the S&P from the end of November, so that kind of makes sense. But we're really close to kind of that point of no return. We break below 210 on the Russell 2000 ETF. That really suggests a much further period of deterioration. The momentum is already quite negative. So I'm concerned about the downside leadership we're observing in the Russell 2000. Now, as this trend is going downwards, I would say the other thing you can do, and you can do this on the chart of the S&P as well, is draw a trend line from the head and the right shoulder, right, or the top, and then those lower highs that we see on the S&P. Here, I'm drawing it on the Russell 2000. And that gives you kind of a stop out, a trailing stop on this downtrend. If you're short the Russell 2000 and you're on a shorter term time frame, you're thinking, all right, when is that short-term pullback probably over? Breaking above that purple trend line, which would be a trend line connecting the swing highs, might be an interesting thing to watch. So, I sort of think of this as we're testing support. If we break 210, I see much further downside. On the other hand, though, if we would break above the purple trend line, which would be the highs from the last 6 weeks, maybe that tells me at least we're pausing that trend and getting a nice bounce to the upside. So I think the chart of the Russell 2000 gives you kind of a framework to think about with some key levels to watch. And generally speaking, as a momentum-based investor, which I am, you're looking for a break. You're looking for a break on stronger momentum, on stronger volume that tells you something new and different is happening. And I think the Russell 2000 gives us some of those things to certainly watch for. Crude oil, important to watch. This isn't updated for today's close just yet, but crude oil closed above $78 a barrel today. So we're continuing to push higher here. You can see it on the chart of the USO having a nice update. As we've mentioned many times, the energy sector is really tied to the price of crude oil. So if you own energy stocks here, whether you like it or not, you are betting on crude oil prices going up, because the chances of energy stocks outperforming as crude oil is going down minimal, right? Because you're basically, these are companies that do better when crude oil is at a higher price level. So what's interesting is, as of Friday, we closed above the 200-day moving average. Today, we appear to be following through on the upside, which means, as I've mentioned many times, you're waiting for signs of accumulation in oil or signs of optimism. I think we're starting to see that. I think $80 a barrel getting above there would be a nice exclamation point on that move. But I've seen enough with the improving momentum, with the break above moving average resistance, to think that energy stocks may actually be an interesting opportunity. And you can see on a relative basis, just on the last couple of weeks, we're seeing a hook higher here. I think still more to prove, because the longer term relative performance has been quite bad. That's because crude oil prices have really gone nowhere over the last couple of years. I mean, look at the sideways nature of this chart over the last 2 years. So, I think energy companies, oil companies, can do much better if and only if you see further upside in crude oil. And if you see that, boy, the XLE and other particular names could be an interesting place to be. Let's continue on and finish off looking at some individual stocks, and I'll take a question or two before we wrap the show today. Mosaic is one of those specialty chemical companies in the materials sector, best sector today. I just want to point out, never get too excited when an individual stock is up a bunch, like 8%. I immediately look at the chart and think about, what does that move mean relative to the longer term trend? The longer term chart of Mosaic, I would argue, still a lot not to like here. And generally, this is a stock that has failed to get above the 200-day moving average many, many times. When you have a chart in a consistent decline, I am super happy being patient and waiting for enough accumulation that we get above that, sort of long-term trend measure. So the 200-day moving average currently around 27.50. Through the course of this week, we power above there. That would be encouraging. We power above this swing high from early November, which means you want to watch Mosaic get above 28. And if those things happen on stronger momentum, which it appears to be building up, that could be a really interesting place to be in a stock that has been so bad for so long. And I think, market history is full of stocks that have had incredible gains after long-term downtrends, but there are always signs of accumulation, signs of a bullish rotation. I think you're starting to see that maybe on a chart of Mosaic, but the big spike higher today, put into context, means I think there's still more to prove from a technical perspective. And I think that's a fair assessment there. I mentioned earnings coming up. Again, as I'm looking forward to this week, we've got inflation data coming out over the next couple of days, which I think will be vital. The market not pricing in any chance of anything but no change to the Fed target rate. Maybe if some craziness happens with the inflation data, could we see a change in that, or certainly a change in what the expectations might be? But for now, the market basically pricing in no change to the Fed target rate. Having said that, earnings season is also kicking off here on Wednesday, and it's a bunch of financial institutions, including JP Morgan. When you look at the financial space, probably one of the better charts you would find would be JPM, because it's currently above two upward sloping moving averages, and a lot of financial stocks are not in that position. They're actually below. The relative strength has improved because the benchmarks, of course, have come down quite a bit. Most S&P names are not above their 50-day moving average anymore, but JP Morgan has managed to hold on there. So I think going into Wednesday, and certainly coming out of Wednesday, the question is, do you get enough upside catalyst from an earnings beat that would propel these stocks to resume their uptrends? JP Morgan, from a technical perspective, I would argue one of the better banks that I'm seeing. But again, this week could be a noisy one. Materials, of course, number one. Steel Dynamics is one of those stocks having a nice rally as well. It's one of the top gainers in the S&P, up about 6%. Now, granted, coming off of a fairly low level. Now, we got down to sort of 105, 107 back here in September. We then retested the April 24 high right around 150. Had this great distribution pattern, what we call a bearish engulfing pattern, and pushing back lower. We didn't quite get to that September low, but certainly got down in that range. We've been oversold from mid-December to now the beginning of this year. And now we've come out of that oversold region. I'm not showing the MACD indicator, but if you look at it, you'll see that starting to hook higher. I'm not a bottom fisher. I'm not a falling knife kind of buyer. I'm not a fan, generally speaking, of these kind of charts. However, if I was a swing trader, these are the kind of setups that would be really attractive to me because you're testing support. We're oversold. All of a sudden, those conditions are alleviating. We're seeing a nice bounce on improving momentum. I think that could be an encouraging rally. I'm watching the 200-day moving average, though not too far above current levels, around 128. Revity, ticker RVTY, is in the healthcare sector. It's really a mid-cap name. It's kind of getting up toward the upper end of that mid-cap space, and not a name you're probably familiar with. It's a medical supply company. But similar to what we saw in the previous chart, I like the fact that we're bouncing off of support. And what was interesting about this chart as I was digging into it after I got a question on it was, if you take the October 23 low, this was actually a big gap lower in what we obviously have to think of as an exhaustion gap, which was a downtrend, and then we gapped lower, but then it was bought, right? Anytime we have a big gap, I always say, look at what happens next. While it's really hard sometimes to predict a gap is going to happen in either ways, we can assess conditions right after that gap. And if you have a gap lower and then we continue to drift to the downside, that tells you even though the stock was given a deep discount from one day to the next, you're not really seeing any signs of accumulation. I would say in this case, we actually are, because you saw the gap was bought, right? We gap lower, you see the stock immediately bounce off of there. So what happened is this is a stock that had been going down. All of a sudden, people are thrilled to own this stock at $80 a share at a 20% haircut overnight, and then immediately pushes the price right back up to the 200-day moving average. From there, we started to recover. We traded up, a couple times to 128, and then pulling below that level. Found support around 107 to 108, which definitely seems to line up with the first Fibonacci support level based on that general uptrend phase in 2024. Now we are bouncing back off of support. The momentum is improving with the RSI pushing above 60, which is all good. I have a wary eye on this level. So how do I play this kind of chart? I patiently wait for it to break above 128, clear this basing pattern, and suggest to me that there's further upside potential. But for now, playing a rally back up to those previous highs makes a little bit of sense to me. All right. That's it for our chart review. I do want to take some questions here and see what's come up. And I appreciate you guys so much watching and asking some of these questions here. I love this. I want to say Savalai, I believe. I hope I pronounced that correctly. Watching on YouTube. Thanks so much for that. How do you choose the individual stocks to highlight? Such random choices today. The random nature of the stocks that I choose, I guess, is probably how my brain works. I'm kind of pulled in a bunch of different directions, and I found I enjoy that quite a bit. I get very bored with routines and consistency, so I have to work really hard to kind of keep things fresh and be shaking things up. So what happens is I have a set of charts that I review every morning. And it's basically this market misbehavior live chart list. And you can access this through the Stock Charts platform, or I think you go to marketmisbehavior.com/charts. Is that true? There we go. Gets to this list of charts. So there you go. If you want to check it out, you're welcome to. I keep this updated on the Stock Charts platform. I start here, but these are all macro kind of big picture charts. The moment I really dig into the trading day, I'm watching the market carpet. I'm immediately looking for things that stand out, right? What's new, what's different. I'm looking at the dashboard to see what stocks are going up and stocks that are going down. And the good news about having a member subscription service, so I have members asking questions. With the videos that I put out, I get people asking about different tickers, and that points me to a lot of random things through the course of the day. So between watching what's up and what's down, focusing on scans that I run for stocks making new 3-month highs and 3-month lows, and just seeing what kind of questions get asked about different stocks, I end up with a good working list of charts to review. And these are things that literally I've been looking at some point during the day. Someone asked about it, or it came up on a screen, and I thought, oh, that might be interesting to talk about. And I put them in here. So I hope you like that kind of randomness to it. And if not, I'm so sorry, because I can't change how my brain works along those lines. But that's what it is. I would say, the good thing for all of us, or I think what would be helpful, is have a good way that you are always looking at ideas. I think that's one thing I took away from my time at Fidelity. We were always talking about random companies. People would always ask about some random stock or see something in the news, and we would dig into it a little more. And I think being a successful equity and ETF investor means you're always just kind of iterating on different things. Someone mentions something, you don't take it at face value, you dig into it a little bit and see, all right, what's my take on this stock? How does that compare to what I heard? And hopefully charts are a way that you can sort of do that. Akira watching on YouTube, do you see the S&P or QQQ in the downturn, or still wait and see whether the channel is broken and confirmed? Is 5783 an area of interest? Does it make sense to use SH in a downturn market? So SH, of course, I'll start there. SH, of course, is an inverse ETF. I don't have a problem with people using inverse ETFs. I actually have used them plenty of times. But I would tell you a couple things you want to think about anytime you use leveraged ETFs or inverse ETFs, but especially inverse leveraged ETFs. Number one, if you're betting on the market to go down, that can be a very profitable strategy in a short-term time frame. What you have to remember, and you can see that on the charts behind me, this one over here is a long-term chart of the major equity averages. And I have that on my wall that I see every day I come in my office, mainly to remind me that generally speaking, all else being equal, the market usually is going up, right? It goes up more than it goes down. The history of the equity markets is a bullish history. 100% of every pullback has been retraced 100%, right? Because the market keeps making new all-time highs. So being bearish can be very profitable as long as your time frame is short enough. Staying bearish is a great way to lose money because the market will recover at some point and you will be on the wrong side of it. So use short ETFs like the SH if you like, no problem with that. I would say as any time you're using an inverse product, a leveraged product, it could be an ETN, just be very comfortable with the structure, look at the spreads, look at the costs involved, look at the risks involved. As long as you're comfortable with all those things, I don't have a problem with using them on shorter term timeframes. Longer term timeframes, not as much. So, what do you do right now? I can't, again, make a recommendation on what you want to use. You asked about a level like a 5840-ish level, I want to say. Sorry, 5783, which is kind of right around here. That's sort of the midpoint of where we are at today. I don't have any particular reason to key in on that level. For me, 5850 was the point. That's the line in the sand. And now that that's broken, I'm immediately thinking my base case is going down to 5600. What happens between now and then will tell me a lot about the market conditions. And again, I'm not a fan of blindly following a trend or a level without really paying attention to the trajectory. And that's honestly why I started a show like this years ago. It was really built off of my own efforts to analyze the markets through the course of the day. And then at the end of the day, what did I learn? What did I see? What was important? What was meaningful? The analysis we're doing on the show is really an add-on to what I do over the weekend, what I call my weekly process, my weekly flight plan, which I share with my premium members, which is basically that's where I really dive into trends and positioning and where I want to be. And then every day you're just sort of incrementally adding new data, right? What did you learn? What was new? What was different compared to those major themes? So given the breakdown on Friday, I think, again, trending downwards is my base case for now. I would love to be wrong about that. And again, having a sense of what you would need to see to switch your mind is important. So for me, I mean, again, drawing a trend line on the small cap ETF, I showed you that earlier. You can do a similar trend line on the S&P and kind of track this downtrend that's been developing. We break back above that. I think we're back to a clear uptrend. But until then, I'm seeing weakness over strength. Folks, thanks so much for asking us some great questions. We had a number of them that I didn't get to today. The mailbag will be thrilled to be refilled with some really thoughtful questions. And I appreciate you guys that are watching me live. If you're watching the replay, I appreciate you too. And as a reminder, thanks so much for watching us on all the different platforms. I can't tell you how much we appreciate if you tell others about the show. If you hit like or subscribe or anything you can do on something that I'm putting out there, it really goes a long way. And I appreciate your thoughtful questions for sure. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.